income from house property. So firstly, we should know the meaning of income from house property. Among the various sources of income that a person can have, income from house property is one of the important heads of income under the Income Tax Act. In most cases, it is rather easy to compute taxable income from house property. At times, however, some complicated problems of computation of income are faced by the taxpayers who do not have legal assistance. The annual value of property consisting of any buildings or lands appurtenant thereto of which the assessee is the owner, other than such portions of such property as he may occupy for the purposes of any business or profession carried on by him, the profits of which are chargeable to income tax, shall be chargeable to income tax under the head Income from House Property. After studying this lesson, you should be able to know the meaning of house property, define the owner of the house property, make the treatment of rental income from properties under different circumstances, determine the annual value of a house property, define the expenses deductible from rental or notional income from house property. Now let's discuss some terms as per Section 22 of the IT Act 1961. It can be understood under following heads: buildings or lands appurtenant, ownership of house property, property used for own business or profession, composite rent, rental income of a dealer in house property, disputed ownership, house property in a foreign country, property incomes exempt from tax. The term buildings include any building, whether occupied or intended for self-occupation, office building, godown, storehouse, warehouse, factory, halls, shops, stalls, platforms, cinema halls, auditorium, etc. Income arising out of the building or a part of the building is covered under this section. Land appurtenant includes land adjoining to or forming a part of the building. It would depend on the nature of the land whether it is appurtenant to the residential building, factory building, hotel building, clubhouse, theatre, etc., and will include courtyards, compound, garage, car parking spaces, cattle shed, stable, drying grounds, playgrounds, and gymkhana. Owner of the house property is liable to pay tax in respect of the income from the house property. Here, owner means the person who can exercise the right of the owner not on behalf of the owner but in his own right. A person who is entitled to receive income from the house property in his own right is treated as owner for the purpose of Section 22 of the Income Tax Act. Deemed owner. A person is deemed to be owner of the house property under Section 27. If an individual transfer a house property to his or her spouse not for adequate consideration, such individual will be treated as the owner of the house property provided the transfer has not been made in connection with an agreement in living apart. Similarly, an individual who transfers otherwise than for adequate consideration any house property to a minor child, not being a married daughter, is also treated as the owner of the house property so transferred. The holder of the impartible estate is deemed to be the individual owner of all properties comprised in the estate. A member of a cooperative society, company, or other associations of persons to whom a building or part thereof is allotted or leased under a house building of scheme of the society, company, or association, as the case may be, shall be deemed to be the owner of that building or part thereof. A person who is allowed to take or retain possession of any buildings or part thereof in part performance contract of the nature referred to in Section 53A of the Transfer Property Act 1882 shall deemed to be the owner of that building or part thereof. The house property must not be occupied by the assessee for the purpose of any business or profession carried on by him, the profits of which are chargeable to income tax. Section 22 does not apply to cases where the owner occupies the house property for the purpose of any business or profession carried on by him. The profits of such business or profession are chargeable to income tax. Composite rent is when the owner of the buildings get along with the rent of the building, rent or hire of other assets like furniture or charges for different services provided in the building. For example, charges for security, lift, air conditioning, etc., where the assessee received composite rent from its tenant towards building as well as services or amenities. Such rent should be split up and the portion of rent attributable to the building should be assessed as income from house property, and the other portion attributable to service or amenities should be assessed as income from other sources. If a person is engaged in the business of purchasing house properties with the purpose of letting them on high rents and disposing of those properties which are not profitable for this purpose, the rental income from such property will not be taxed as business income. Any rent from house property, whether received by a dealer or a landlord, is taxable under the head income from house property. It will remain so even if the property is held by the assessee as stock in trade of a business, or if the assessee is a company which is incorporated for the purpose of building houses and letting them on rent. Disputed ownership is that if the title of ownership of a house property is disputed in a court of law, the decision as to who is the owner rests with the income tax department. Mere existence of dispute as to title cannot hold up an assessment even if a suit has been filed. Generally, the recipient of rental income or the person who is in possession of the property is treated as the owner. A resident assessee is taxable under Section 22 in respect of annual value of a property in a foreign country. A resident but not ordinarily resident or a non-resident is, however, chargeable under Section 22 in respect of income of a house property situated abroad, provided income is received in India during the previous year. If tax incidence is attracted under Section 22 in respect of a house property situated abroad, its annual value would be computed as if the property is situated in India. In some cases, income from house property is completely exempt from any tax liability. Income from any farmhouse forming part of agricultural income. Annual value of any one palace in the occupation of an ex-ruler. Property income of a local authority. Property income of an authority constituted for the purpose of dealing with and satisfying the need for housing accommodation or for the purposes of planning development or improvement of cities, towns and villages or both. Property income of any registered trade union. Property income of a member of a scheduled tribes. Property income of a statutory corporation or an institution or association financed by the government for promoting the interests of the members either of the scheduled caste or scheduled tribes or both. Property income of a corporation established by the central government or any state government for promoting the interests of members. Now let's discuss computation of income from let-out house property. In respect of a let-out house property, the rent received is usually taken as the annual lettable value. When, however, the rent is not indicative of the actual earning capacity of the house, the notional value will have to be found out. The standard rent in the case of properties subject to rent control legislation, the annual lettable value fixed by the municipal authorities, rent of similar properties in the locality, the cost of construction of the property are the facts which will determine such notional annual value. In the case of property that is rented out, the gross annual value is the municipal value, the de facto rent, whether received or receivable, or the fair rental value, whichever is the highest. If, however, the Rent Control Act applies to the property, the gross value cannot exceed the de facto rent or the standard rent under the Rent Control Act, whichever is higher. Actual rent is actually received by the owner of the house property from the tenant. In case tenant paid composite rent, that is rent of building, plant and machinery, furniture, etc., and the rent is separable, actual rent is reduced by the amount of rent of plant and machinery, furniture, etc. Balance is actual rent of house property. Any amount of local taxes paid by tenant, cost of repair borne by tenant, or any interest on advance deposit is not to be added. For the purpose of levying local taxes, the local authority, that is municipal corporation or committees, etc., conducts a periodical survey of the house properties in their local limits. On the basis of such survey, the rental value are fixed, which serves as the basis for levying tax. The rental value so fixed is called Municipal Rental Value, MRV. Fair rental value of a house property is based on the rent prevailing for similar type of accommodation in same or similar type of locality. It is based on the principle that rent prevailing in same locality for similar sized property is almost the same. The rent fixed under Rent Control Act, wheresoever applicable, is called standard rent. From the annual value as determined above, municipal taxes are to be deducted if the following conditions are fulfilled. The property is let out during the whole or any part of the previous year. There is no such deduction in respect of one self-occupied house property for which nil annual value is adopted. The municipal taxes must be borne by the landlord. If the municipal taxes or any part thereof are borne by the tenant, it will not be allowed. The municipal taxes must be paid during the year. Where the municipal taxes become due but have not been actually paid, it will not be allowed. Similarly, the year to which the taxes relate to is also. Now let's discuss deductions under Section 24. They are statutory deduction, interest on borrowed capital, interest attributable to period prior to construction. Statutory deductions are a sum equal to 30% of the annual value, where the property has been acquired, constructed, repaired, renewed or reconstructed with borrowing capital, the amount of any interest payable on such capital. Interest on borrowed capital is when money is borrowed on interest and the property in question is either acquired or constructed or repaired or reconstructed with such borrowed funds, interest payable thereon is deducted from the annual value. The amount of interest payable for the relevant year should be calculated and claimed as deduction. It is immaterial whether the interest has actually been paid during the year or not. However, there should be a clear link between the borrowal and the construction or purchase, etc. of the property. If money is borrowed for some other purpose, interest payable thereon cannot be claimed as deduction. Interest attributable to period prior to construction are: money may be borrowed prior to the acquisition or construction of the property. In such a case, interest paid or payable before the final completion of construction or acquisition of the property will be aggregated and allowed in 5 successive financial years, starting with the year in which the acquisition or construction is completed. This deduction is not allowed if the loan is utilized for repairs, renewal, or reconstruction. Special note relating to interest are: in case the property is let out, the entire amount of interest accrued during the year is deductible. A fresh loan may be raised exclusively to repay the original loan taken for purchase or construction, etc. of the property. In such a case also, the interest on the fresh loan will be allowable. Interest payable on interest will not be allowed. Brokerage or commission paid to arrange a loan for house construction will not be allowed. When interest is payable outside India, no deduction will be allowed unless tax is deducted at source or someone in India is treated as agent of the non-resident. Now let's discuss computation of income from self-occupied house property. It comes under two heads. Annual value of one house away from workplace. Section 23, Part 2, Part B. Annual value of house property which is partly self-occupied and partly let out. To understand annual value of one house away from workplace, let's see an example. A person may own a house property in Bangalore which he normally uses for his residence. He is transferred to Chennai where he does not own any house property and stays in a rental accommodation. In such a case, the house property in Bangalore cannot be used for self-occupation and notional income. Therefore, would normally have been chargeable although he derives no benefit from the property. To save the taxpayer from hardship in such situations, it has been specifically provided that the annual value of such a property would be taken to be nil subject to the following conditions. The assessee must be the owner of only one house property. He is not able to occupy the house property because of his employment, business, etc. away from the place where the property is situated. The property should not have been actually let or any benefit is derived therefrom. He has to reside at the place of employment in a building not belonging to him. If a house property consists of two or more independent residential units, one of which is self-occupied and the other unit is let out, the income from different units is to be calculated separately. The income from the unit which is self-occupied for residential purposes is to be calculated as per the provisions of Section 23, Part 2, Part A. That is, the annual value will be taken as nil and only interest on borrowed capital will be deductible up to a maximum limit of rupees 1,50,000 or rupees 30,000 as the case may be. The income from the let out units will be calculated in the same manner as the income from any let out house property. If a house property is self-occupied for a part of the year and let out for the remaining part of the year, the benefit of Section 23, Part 2, Part A is not available and the income from the property will be calculated as if it is let out. Now let's discuss some special provisions. First one is taxability of unrealized rent recovered later, Section 25A, where any rent cannot be realized and subsequently if such amount is realized, such an amount will be deemed to be the income from house property of that year in which it is received. We have seen earlier that the basic requirement for assessment of this income is the ownership of the property. However, in the cases where unrealized rent is subsequently realized, it is not necessary that the assessee continues to be the owner of the property in the year of receipt also. Second is assessment of arrears of rent received. Section 25B. When the owner of a property receives arrears of rent from such a property, the same shall be deemed to be the income from the house property in the year of receipt. 30% of the receipt shall be allowed as deduction towards repairs, collection charges, etc. No other deduction will be allowed. As in the case of unrealized rent, the assessee need not be the owner of the property in the year of receipt. Third is house property owned by co-owners, Section 26. If a house property is owned by two or more persons, then such persons are known as co-owners. Co-owners are not taxable as an association of persons. When the share of each co-owner is definite and ascertainable, it has been provided that each of the owners will be assessed individually in respect of share of income from the property. In other words, income from the property will be determined and allocated to each co-owner according to his share. Next is house property owned by co-owners, Section 26. If the aggregate amount of permissible deductions exceeds the annual value of the house property, there will be a loss from that property. So far as income from a self-occupied property is concerned and in respect of a property away from the workplace, the annual value is taken at nil and no other deductions are allowed except for interest on borrowed capital up to a maximum of rupees 30,000 or rupees 1,50,000. Now let us check if we have understood the various concepts discussed in this lesson clearly. The term buildings includes any building, office building, godown, storehouse, warehouse, factory, halls, shops, stalls, platforms, cinema halls, auditorium, etc. Right or wrong? Right. Deemed owner means the person who can exercise the right of the owner, not on behalf of owner but in his own right. Right or wrong? Wrong. Disputed ownership is that if the title of ownership of a house property is disputed in a court of law, the decision as to who is the owner rests with the income tax department. Right or wrong? Right. Now let's revise what we have studied till now. Under Section 22 of the Income Tax Act, the annual value of house property consisting of buildings and lands appurtenant thereto is taxable under the head Income from house property in the hands of the owner of the property, provided that the property is not used by the assessee for the purpose of his own business or profession. For determining the annual value of the house property, the actual rent received or receivable from the property, the municipal valuation, the fair rental value, and the standard rent under the Rent Control Act are taken into account. From the gross annual value of the property, the municipal taxes are deducted to arrive at the net annual value. Section 24 of the Income Tax Act provides that 30% of the NAV and the interest on borrowed capital shall be deducted from the NAV to obtain the taxable income from the house property. As per Section 23, Part 2 of the Income Tax Act, the annual value of one self-occupied house property is taken to be nil. No deductions are permissible from the annual value of such property except the interest on borrowed capital, subject to the maximum limit of rupees 1,50,000 or rupees 30,000 as the case may be. The above provisions may result in loss from house property which may be set off against income from another house property or against incomes under the other heads. The balance loss may be carried forward to be set off against the income from house property up to a maximum of 8 assessment years.